already completed weighted average cost of capital. Let's solve some more questions of cost of capital and wrap it up. If a company's income tax rate increases, the after-tax cost of the company's fixed rate debt will be what? See, the formula is cost of debt, interest rate multiplied by 1 minus tax rate. Now, there are two kinds of interest rates. One is fixed and one is floating. Fixed interest rate means for the entire tenure of the loan, the interest rate is fixed. It will not change. Floating, on the other hand, keeps on changing. It is generally pegged. Pegged means it is adjusted against some standard benchmark, can be RBI, repo rate, prime rate, or anything. So in this case, what are they asking? That if the company's income tax rate goes up, what will happen to the after-tax cost of the company's fixed rate debt? So let's say earlier interest rate was 10% and tax rate was 40%. So cost of debt was coming as 6%. Now let's say now interest rate is still 10, but tax rate increased, right? So let's say it increased from 40 to 50%. See, after tax cost of debt declined. And there is a clear-cut logic behind it. Because if tax rate goes up, more proportion of your interest expense is now tax deductible. So debt becomes more attractive actually when tax rate increases. Debt generally becomes more attractive because after tax cost of debt falls because of the high tax rate. So this is your answer. Clear? Beck Inc. issued. Beck Inc. issued $100,000 15-year term bonds. The company has issued $100,000 15 years term bonds with a coupon rate of at par. Interest is paid annually to bondholders. And Beck's effective tax rate is now. Beck used the proceeds to complete the purchase of a. What is the after-tax cost of debt? What has happened here? See, there is a company Beck. They went ahead and they issued bonds, 15-year, 8% bonds for 100,000. Once the money was received, what did they do with the money? They went ahead and used the money to purchase a supplier. That is what is written there. To purchase a. And the tax rate that is relevant to the supplier is 20%. They are asking what is after-tax cost of debt. Now, please listen carefully and then understand, of course. I have issued 15-year 8% bonds at par. Now, what I do with that money has nothing to do with my cost of debt. Cost of debt is very simple. Interest rate, in this case, since it was issued at par, it will be 8 only, into 1 minus tax rate. What I did with that money has no influence whatsoever. So what's the tax rate? 35%. So it is 8 into 1 minus 0 point. What's the answer? Always remember, bonds generally have the lowest after-tax cost. Why? Because finance, risk and return go hand in hand. Bond holders are taking the lowest amount, quantity or amount of risk, because no matter whether company makes a profit or company makes a loss, company has to pay them interest. So it is generally the cheapest source of finance for a company. Of course, there is risk involved, because if profits are not there and you are not able to pay them interest, they can push you towards bankruptcy. But the concept still remains same, that these are the people who have given you money for a certain purpose. So they charge generally the lowest amount. Preferred a little more because there is risk with dividends. Common stock highest because they are partners in your business. Their future and company's future are intertwined. A firm must select from among several methods of financing arrangement. So there is a company and they should select among several methods of financing arrangement when meeting its capital requirements. To acquire additional growth capital, to acquire additional capital, which will be used for growth while attempting to minimize its cost of capital. What should the company do? If you want to minimize your cost of capital, you should have some debt in it. Overall, yesterday when I was solving also, you would have seen if more proportion of debt was there, WACC was falling. So see, A, discontinue dividends and use current cash flow, which avoids the cost and risk of increased debt and dilution of current common shareholders' ownership caused by increased equity. First of all, if you have studied dividend policy, dividend, lot of shareholders purchase shares with the hope of getting dividends. So you just can't discontinue dividends. But let's say even if that is the case, cost of retained earnings is not nil. You want to minimize your cost of capital. There is only one difference between cost of retained earnings and cost of equity, flotation cost. Apart from that, there is no difference whatsoever. So if I use retained earnings also, my overall cost of capital will go up only. B, select equity over debt initially. Nah, because this will increase my cost of capital. Yes, it will minimize risk and avoid interest cost, but they are asking while attempting to minimize the cost of capital. Select debt over equity initially. Yes, ideally this should be done. Even though increased debt is accompanied by interest cost and a degree of risk. Okay. You means I may or may not go with this absolutely. And D, attempt to increase both debt and equity in equal proportion, which preserves a stable capital structure and maintains investor. Now this gets confusing. Let's read again. A firm must select from among several methods of financing arrangement. Yes, when meeting its capital requirements. Fine. To acquire additional growth capital, more money, while attempting to minimize its cost of capital. So, of course, if you want to minimize, debt has to come. The word used is should normally. Means normally only that should be done. Should word tells you that normally that should be the correct approach. Rest all approaches may not be taken. This I am liking more than D because Normally, a company may not choose to increase debt and equity in equal proportion. Debt is generally a little higher. So I chose the purest logic. This word, normally. That is why should normally all these words should be very carefully read in the exam. It's a, many of you start shouting that examiners are playing games with you. And no, dear, they don't have time, nor are they playing games. The logic is very simple. You have to be careful with what answers you are selecting because this is corporate finance and these are real life scenarios that happen. So try to understand and read each question carefully. Even though formula is very basic, but you need to understand. Since weighted average cost of capital is computed by taking all the capital, their weights, that is ratio, and cost. So ultimately, that is why company wants to find an optimal capital structure where risk is lowest and cost is also lowest. You need that. You cannot have only equity because otherwise your cost of equity, cost of weighted average cost of capital will be very high. And that weighted average cost of capital is using capital budgeting generally, adjusted discount rate. So you will have too much requirements from every project. You might not get that many high projects, that kind of money to invest. This is your homework. There is nothing for me here. I have already taught the formula. It's net issue proceeds. Which of the following is not a true statement about a company's cost of debt from an accounting perspective and its cost of debt from a capital perspective, cost of capital? A. Cost of debt from an accounting perspective uses the effective annual interest rate. True. Cost of debt from cost of capital perspective uses the investor's required rate of return, which is the current market rate. Are effective interest rate and current market rate are same only. B. Cost of debt from cost of capital perspective is the effective annual interest rate of the company's outstanding bonds. Correct. When they were originally issued. Correct. Whereas the cost of debt from an accounting perspective is the market interest rate at any given moment. Now, cost of debt from an accounting perspective is always the date they were originally issued. You can say actually the reverse, that cost of debt from capital perspective is generally the current market rate because you are calculating, see, if you guys remember how bond prices were calculated, we used to discount them to their present value using cash flows. And that was done using market rate of interest on the date of issue. Now, in accounts or in accounting perspective, we will not change the interest rate later. We will continue to use the same interest rate or yield or market rate which was prevalent on the date of issue, unless it's a floating bond in which on certain dates interest is reset. But when you are doing from cost of capital perspective, you have to remember at any given moment when you are computing, you will use the current market rate, which may have gone up or may have gone down, depending on what happened in the intermediary or intermediate period. Whether the inflation went up, went down, repo rate went up, went down, savings went up, went down. It all affects the same. So this B, when what is they are writing in B? If you see cost of debt from a cost of debt from a cost of capital perspective is the effective annual interest rate of the company's outstanding bonds when they were originally issued. No, this is accounts perspective. Whereas the cost of debt from an accounting perspective is the market interest rate at any given moment reduced for the tax deductibility. Generally, we do not do this. C. Cost of debt from an accounting perspective considers the coupon rate of bonds, yes. And cost of debt from a cost of capital does not, yes. Nothing to do with coupon rate at all. Cost of debt from an accounting perspective is based on the amortized book value. In part 1, section A, accounting for bonds, you will understand how discount and premium works. Accounting for bonds, yes, it's true. Cost of capital is based on the market value, true. This is the wrong statement. Homework. See this, okay, I am solving it. If Brewer Corporation bonds are currently yielding 8% in the marketplace, why is the firm's cost of debt lower? A means bonds are currently yielding 8%. So market rate of return is 8%. So they are asking why is company's cost of debt lower? They are not saying WACs. A. Additional debt can be issued more cheaply than the original debt. Maybe. But if additional debt can be issued more cheaply, why is yield 8%? Yield should fall. C. There should be no difference. No, they are to telling there is a difference. D. Market rates have gone up. If market rates have gone up, your bond will be expensive. Cost will be higher, not low. Because interest is deductible for a part of your cost will be beared by authorities. I think preemptive right or rights issue I have discussed with you all, where the existing shareholders generally have the right to purchase shares or participate in a new stock ownership proportionate to their original ownership capital structure. We have discussed this. This is what is preemptive rights. Clear? This was discussed in which section B only, I think. Repurchase and all. A finance manager usually will prefer to issue preferred stock rather than debt because preferred dividend is not an obligation. Debt is. Why? Because preferred dividend is often cumulative. Interest payments are not. Who told you? Interest payments are to 100% cumulative. If you are not paying interest for one period, next period you will have to pay all the periods interest together. It's always cumulative and that to 100%. B. Payment to preferred stockholders are not considered fixed payments. No, again, not the most accurate answer because preferred dividend is generally fixed only. In a legal sense, preferred stock is equity. Yes. Therefore, dividend payments are not. So, if you have a bad year, you can choose not to declare the dividend. And they cannot take you towards bankruptcy. The cost of fixed debt is less expensive. Yes. Since it is tax deductible, even if a sinking fund. Yes. So then I should issue debt now. It's written in reverse. You are understanding, right? Try to watch the video again. You guys. Preferred stock may be retired through the use of anyone. Retired means settled. Through any one of the following except sinking fund. Yes, you can have a sinking fund like bond for preferred stock also. Call provision. It was discussed in bonds when company has the right to call back the bonds, in this case preferred stock, prior to maturity at a pre-agreed price. And conversion, yes, it can be converted to equity, but refunding is not something that is a term used. You can, means refunding is not a term. Refunding means what happens? Generally, it is done for bond. Company issues a new bond, takes the money and refunds the old bonds. But generally, preferred stock, it's not generally done. What is the biggest disadvantage to issue a preferred stock? Generally, from compared to bonds, you have to pay little extra. Your yield will be comparatively higher. See this. Equity section of Smith Corporation's balance sheet is presented below. Preferred stock $100 par, 12 million. Common stock $5 par, 10 million. 10 million means 1 crore. And if 5 is par, so divide by 5, 20 lakh shares are there. Paid in capital in excess of par. Securities premium in Indian context. These people call it EPIC, additional paid in capital. 18 million and retained earnings is 9 million. So net worth of the company is 49. The common shareholders of Smith Corporation have preemptive rights. That means if Smith Corporation wants to issue new shares, first they have to offer them to existing shareholders on a proportionate basis. Whatever is their share, so that they can have the same ownership percentage. If they refuse, only then they can sell those shares in the market. So see, if Smith Corporation issues 4 lakh additional shares of common stock at 6 per share, a current holder of 20,000 shares must be given the option, right, not an obligation, to buy how much? First, common stock $5 par is given as 10 million. And so number of shares, total par value 10 million, 1 crore, and par value of one stock 5. So number of shares 20 lakh or 2 million. Now what are they telling? The company issues 4 lakh additional shares. At $6 per share. A current holder of 20,000 shares must be given the option to buy. So let's say there is a guy, Mr. A, and that Mr. A is holding 20,000. See, if you have forgotten, you can again revise. What is preemptive right? Preemptive right tells that, and this is generally there in the charter of all companies in India, US, and everywhere, that if the company wants to issue new shares, they have to first give existing shareholders the chance to buy such a number of shares so that their existing ownership percentage in the company is intact. Only if the existing shareholders do not accept this can company sell it to outsiders. Now the thing is, see, Number of shares in the company, 20 lakh. And number of shares that they want to issue, or I can do it better. Number of shares held by Mr. X or Mr. A, 20,000. What is the current percentage ownership? Of Mr. A in Smith Corporation? Hmm? 20,000. That is the number held by him. Total is 20 lakh into 100%. Hmm? That is 1%. Now, what is the new number of shares company wants to issue? 4 lakh. So in 4 lakh also they will have to offer him 1% shares. Offer. He may or may not buy, but they will have to offer 4,000. That is 4 lakh into, because if he, but now by offering company has fulfilled its duty because Mr. A chooses to exercise the option. In that case, his ownership will still remain 1% only. That is preemptive rights. Homework. What is par value of a common stock? Okay, let me discuss. Is it the total value of a stock that must be entered in the issuing company's record now? Total value goes to par value and also towards the additional paid-in capital. Is it market value? Nah. Par value is the face value. C. Generally this. The liability ceiling of a company. So in case of bankruptcy, company is maximum liable to pay you only par value to equity shareholders. Market price is irrelevant. Like see, Nestle and I think TCS market price is still 2,400 or something. Or whatever, 24, 25. Par value, if I'm not wrong, is 1 rupees. So in the case of bankruptcy, company is not liable to pay you max 1 rupee max. Does not mean company will pay you 1 rupee. It depends on how many assets are remaining. But par value or face value is what the company promises to pay you in the event of bankruptcy. This is the maximum. This is the ceiling. Homework. Homework. See, which one of the following statements is correct regarding the effect preferred stock has on a company? So they are telling that which one of the following statement is correct regarding the effect preferred stock will have on a company. Firms after tax profits are shared equally by common and preferred stockholders. Not at all. They will only get their fixed share of dividends. Non-payment of preferred dividends places the firm in default. No. As does non-payment of interest on debt. Is it same? No. So A and B both are wrong. Control of the firm is now shared by the common and preferred shareholders, with preferred shareholders having greater control. Wrong. Control is not shared with them at all. D. Yes. Preferred shareholders' claims takes precedence over the claims of common shareholders in the event of, this is the standard. that in the case of bankruptcy proceedings, these people will be paid first. Preferred stock is called preferred stock or preference shares because it has two rights of over equity shareholders. First, right to payment of dividend. They will be paid dividend before. And second, right to repayment of capital. In the case of bankruptcy or winding up, they will be paid their capital first. See, this is similar to the question I have already solved today. Please solve this right now only. Yes, 2000 is correct. Good. Which one of the following rights is ordinarily sacrificed by the holders of preferred stock in exchange for other preference received over common shareholders? Rights to share in the residual assets of the company upon liquidation, none. They don't have any right to receive residual asset. Right to accrue dividend payments in arrears when payments are not made for a period of time. No, this to generally preferred shareholders keep cumulative. Right to vote for members of the board of directors, and in the other matters requiring they don't have the right to. So simple. Cost of capital and weighted average cost of capital, if you guys can just study. See. Okay, this I will just solve. Is it differing growth rate? Yes. I'll solve it today only. Assume that nominal interest rates, nominal means whatever the market is offering, nominal interest rates just increased substantially. But the expected future dividends for a company over the long run were not. As a result of increase in nominal interest rate, what will happen to the stock price? It should fall. See, if you remember one formula, you will not need to remember the other formula. I taught you KE, and I'm not talking about growth or no growth because they are not talking. So I told you KE in case of no growth is D0. That is whatever the dividend you are paying today or tomorrow. It's all same only. Divided by P0. That is the current market price. This is what I taught you, right? Now, from the same formula only you can calculate the price. How? You just need to switch sides. This PE will go to the left hand side and KE will come to the right hand side. So if PE is in division, it goes to the left hand side. PE right now is in division, right? If it goes to the left hand side, it will become P0 normally. And this D0 will remain as it is. And that KE is in multiplication or normal sign. It will come as K. Same it is getting derived from. Now what has happened? If nominal interest rates have gone up substantially, not slightly also. That is what is written here, right? What is the question telling? Substantially. These kind of questions are where student gets confused because their concepts are not clear. भगवान नहीं आएंगे क्वेश्चन सॉल्व करने, आप लोगों को ही करना होगा. Now, how does it work? I always say put numbers. Your life will become easy. P0, let's say your current price. Let's say currently dividend they were paying was 10. and current cost of equity was 0.12, let's say. What is the price? 12% cost of equity. I'm writing it as KE. So you generally write it as 0.12 only. What is the value? 83 point. Now understand, if nominal interest rate go up significantly, cost of equity will also go up because risk-free rate goes up, cost of debt shoots up, so cost of equity will also shoot up. CAPM model or any other common model will give you the same logic. So in this case, let's assume this 12 has become 15. What's the price now? Price will decrease because there is no other way. Same dividend you are paying. On the other hand, the rates have increased. Shareholders want more. So price will have to fall. Clear? This was a good question. It's a very good question. I will solve this. Let's have a break, then I'll continue. Thank you.